Hello and welcome to our day 2 of financial reporting sessions. The focus of this session is some concepts and conventions of accounting, and we'll understand these concepts and convention while examining the accounting equation. And this entire process of understanding accounting concepts and conventions through accounting equation will do through an example. So these are the set of business decisions taken by a company, a group of friends, ABC. They started business in the form of a company and to buy and sell books. And they call that firm as ABC Limited. And then in the process, they have taken several decisions during the period. So what we will try to do is pick up each business decision, understand what is that decision is all about, and convert these decisions into equation. And while doing that, we will understand the relevant accounting concepts. So the first point is that ABC started a company called ABC Limited. So the first question is, the accounting equation is of ABC or ABC Limited. As per the accounting concepts, as I mentioned, while doing these, converting these decisions into equation, we will pick up certain accounting concepts. The first one is a business entity concept. Okay, business entity concept. And the business entity concept says the business and the owners, business entity concept. The business entity concept says the business and the owners are treated as two different entities. So therefore, the personal transactions of the owners will not be recognized or recorded in the transactions in the books of the entity. So therefore, this accounting equation is of ABC Limited, not of A, B, and C. And that is the business entity concept. So A, B, and C gave money to the company, and as per the accounting equation, if you have assets, in this case the asset is cash, the asset should have a corresponding source, and in this case the corresponding source at this date is capital. So therefore you can see that source is equal to assets, and the asset is cash and capital is the money contributed by the owners, who are the shareholders, and this is the equation of ABC Limited. So this cash now belongs to ABC, does not belong to A, B, and C. And this cash, which is an asset of ABC, is supported by a source, and that source is the capital, which is also called the owner's money. They purchase, that means the company purchase books because that is their main business. Purchase books for cash 125,000. So now they converted the cash, or the company used the cash to buy books. And books are considered to be an asset because books will be sold to earn profit. So therefore, cash reduces and a new asset comes into picture, that is the books. No change in the capital and no other source as of now. Now you see purchase books once again from Z Limited on credit. So the first question should come to mind. This is a credit transaction and we are going to pay the cash later. The company is going to pay the cash later. Should this transaction be recorded? So the answer to that question is, of course they have to record because of the accrual concept. The accrual concept says that the transaction should be recorded as and when the transaction happens, independent of the fact whether the cash is received or cash is paid later. So therefore, the business acquires some more stock, so of books. So the books increases to the extent of 50,000. No change in the cash, no change in the capital, but another source comes into picture and that is called the creditor. So creditor, okay, the creditor, I'm sorry for that. Creditor is a source and is a liability. Creditor is a source and a liability. So now what happened here? We recorded this transaction even if it is on credit because of the accrual concept. So creditor, okay, creditor is a liability. Creditor is a liability, and because you have to pay money to the person at a later stage. And this creditor is for the purchase of goods. And the credit transactions are recorded because of the accrual concept. Now, purchase laptops for cash. So laptop is another asset because it helps the business in running the business, APC in running the business. So laptop is an asset, and but this we purchase, the company purchased by paying cash. So cash will reduce to the extent of 60,000. So reduction of cash, increase of another asset, that is laptop. So no change in the books because of this transaction. No effect on the capital because of the transaction. No change in the creditor because of this transaction. However, you can observe we did not include laptop into these books. We maintain different identity because books are considered to be revenue goods. Okay, books are considered as a revenue goods. That means that is, but books are purchased to make profit, to sell and make profit. Whereas the laptop has been purchased to run the business, to maintain the books, okay? And they are called capital goods. So we have to be clear that in accounting, there is a distinction between the revenue goods and the capital goods. The revenue goods are those goods which are purchased to trade, which are manufactured to trade and make profit. Where the capital goods are those goods which will be used throughout the year, are not meant for resale to make profits. Okay. So in the process, we should hope you are also able to observe that accounting makes a distinction between different types of assets. All assets are not just clubbed together. So slowly we'll also observe different types of assets. Now we'll go to the avail loan, the company avail loan. So as a result, cash will increase to the extent of 50,000. And a new liability comes into picture, and that is called 10% loan. Okay, 10% loan is 50,000, and loan is an outsider's money, right? Capital is a owner's money. Capital is a owner's money. Is a money contributed by the owner, whereas the loan is a liability, outsiders money, and is a liability. Okay, so therefore, when we see later, when we'll understand the complete accounting equation, we are not only converting the business decisions into the accounting equation, but we are also examining and understanding certain important vocabulary which will become the foundation for the rest of the conversation. Along with that vocabulary, we're also understanding the relevant business, the relevant accounting concepts. Now, sold 30% of the stock. You see this? There is stock of, okay, let us complete the transaction. No change in laptop, no change in books, no change in the capital, no change in creditor, and no change in the loan. Okay, we can see the sources are 400,000 supported by the assets, which is 400,000. So at any point of time, the accounting equation will be source equal to assets. Now, observe at this point that the company is having stock of 175,000 and they're selling 30% of the stock on credit for 250,000. What does that mean? First, let me ask a question, bring a question to the conversation, that should we record this transaction? We are not going to get cash immediately. The answer is yes, because of the accrual concept. The accrual concept says both the cash and credit transactions should be recorded as and when the transaction happens. So therefore, this has to be recorded. But are you getting the money now? No. We are going to get this money later. And what is that money, or when will you get that money? We don't know. We'll see that whenever we get the money, at that moment, the cash will be shown. But now I'm not receiving cash. Huh? But we know that we will receive cash. From whom? From my customer. Let us give a name to that customer. Suppose M Limited. Okay, I sold goods of 250,000 to M Limited. So M Limited is going to give me money, okay? And we give a name to that M Limited. Okay, I'll just write down M Limited, but more important is an accounting term called debtor. At this case, in this example, M is a debtor. So who is a debtor? Debtor is a person, okay? Debtor is an asset, huh? Because money receivable, we are going to receive money from Mr. M, okay? Money receivable, so therefore it is an asset for me. Whereas creditor is a payable, is a liability. So creditor is a payable, is a liability. So the money that I'm going to receive from M is 250,000. Why am I receiving? Why will the company receive money? Because they sold goods. How much they sold goods? The books are 30% of the stock sold for 250,000. So how much stock is left? Stock left is 70%. Okay, and no change in the laptop, no change in cash because it is on credit, no change in the capital, no change in the creditor, no change in the loan. But observe, the total of the sources is 400,000. Observe here. The total of assets is 597,000. So there is a new term here, new item which is visible by calculation is called profit. So profit that we are making is 250,000 minus 175, okay, minus 122. That means I'm making a profit of, okay, I'm making a profit of 250 minus the cost of the goods sold. And the cost of the goods sold is 175,000 minus 122, or it is 30% of 175. Okay, so we are calling this profit, and this profit will become the focus of our conversation, you know, as we move along, not only in this exercise but the future exercise too. So at this juncture, you want to know, how did I make the profit? So sales, you can see that here. Sales is 250, okay? Sales is 250. Cost of goods sold is equal to 30%, 0.30. So therefore, the profit is equal to 197. You can see that, okay? Profit is equal to 197. Okay, so at this juncture, we have 2 to 3 things to understand. Why I'm deducting only 52,500? Because only 30% of the stock sold. So therefore, there is another important concept called matching concept. The matching concept says profit should be determined. Profit should be determined by deducting from the revenue the corresponding cost. Profit should be determined by deducting from the revenue the corresponding cost. Okay, the corresponding cost here, we got 250,000 sales, but this sales is from by selling only 30% of the goods. So therefore, the profit will be calculated by deducting only 30% of the cost of goods, and that is called the matching concept. The matching concept also says all the expenses incurred to earn this 250,000 should be deducted to determine profit. For the time being, we have incurred only cost of the goods sold. But let us see, so therefore, by now we have seen 3 important concepts. One is a business entity concept, the accrual concept, and matching concept. Now, salary for the year paid. Now, the moment that I bring in year, that means I'm actually preparing the determining profit for a particular period. And that concept is called accounting period. Accounting period concept says accounting happens regularly, recurring, day to day, real time. But the determination of profit happens at for a particular period. Normally for a listed company, for any company for that matter, we take accounting year as 1 year. But for a listed company, they are also required to show quarterly. So period for which we determine profit. So since here is very specifically mentioned, so we are doing this, everything, we are assuming that this information of ABC Limited is for 1 year. So salary paid. So salary paid is I'm going to deduct cash because I paid money. No change in the books, okay? No change in the laptop. No change in the debtors. No change in the cash, capital. No change in the creditors. No change in loan, okay? Because this particular transaction is not. However, my profit will reduce by another 50,000. Okay. So let us keep on checking that also here. So I'm sorry for that. Let me hide. Okay. So yes. So profit is equal to, and more expenses come up, and that expense is salary. Okay. So profit is equal to sales minus cost of goods sold minus salary, okay, minus if any other expenses. So profit at this juncture is 147,000. Observe this, 147,000. So at this point, once again, you want to check the totals of the sources. The total of sources is 547. You can see at the bottom of the screen. And total of the assets is 547. S will be equal to A. So the accounting period here in this example is 1 year. Okay. Sometime you can do it for a quarter, for a month, for daily also. Okay. Now, interest paid, you can ask a question on for how long, for what is a period. You can see that loan is for 10%. So obviously it is for 1 year. I'm paying the interest of 10% on 50,000, that is 5,000. So once again, my cash, the company's cash will reduce by 5,000. No change in the books. No effect of this transaction on the laptops, no effect of this transaction on the debtors, no effect on the capital, no effect on creditors, no effect on 10% loan of this transaction, but the profit will reduce by 5,000. Okay, let us put that as interest. Okay, interest is 5,000. So profit is now 142,000. Okay, this is just to verify. Okay, this we will develop as called an income statement. That we'll do it later. This is only a working note. So all that I'm doing and from the row number 15 down is to explain what is happening in the accounting equation. Now, sales commission, due but not paid. So your question should be just like any other expenses here. It is an expense, but I have not paid. The company did not pay. But even if the company did not pay, we have to record it, and because of the accrual concept. The accrual concept says expenses paid will be recorded. Goods purchased for cash will be recorded. Purchased laptops for cash will be recorded. Similarly, if some expense is not paid also, you have to record and create a payable, just like credit purchases, just like credit sales. If any expense not paid will also be recorded. So therefore, I'm not going to affect, this is not going to affect the cash, but this is an expense. So since this is an expense, so the profit will reduce to the extent of by 60,000. Okay, we'll write down as sales commission, and profit will reduce by 60,000. You see that? So profit is equal to sales minus expenses, and the sales is 250, expenses as COGS, salary, interest, and commission. Okay, but did you pay money? No, the company did not pay. But why it is, if it is not paid, why should we record it? Because of the accrual concept. But the way we created creditor here, you have to create commission payable. Okay, we have to create a liability called commission payable. So commission payable is an expense not paid. Okay, expense not paid. So how much? The commission payable is 60,000. Okay, commission payable is 60,000. Sorry, got stuck. Is 60,000. So, okay, so yes. So commission payable is 60,000. Let me create here. It got stuck. Okay, so 60,000. So commission payable is equal to 60,000. 60,000, and the profit has come down by 60,000. No change in the creditor, no change in capital, no change in cash because of this transaction where you did not pay money, no change in books or stock because you did not sell anything more, and debtors remain same. Let us see the total of assets. Total of asset is 542 and total of sources is 542. So therefore, business entity concept, accrual concept, matching concept, accounting period concept are some of the important and fundamental principles which govern the process of recording of the transaction. Now let us see this one. Took a shop on rent and paid advance, and shop will be occupied from maybe next year. So this is not an expense for the current period, will be used next year. However, we paid money for that, okay? The company paid money. So it is not an expense. I'm going to create this benefit of this will be reaped or will be taken in the next year. So therefore, this is an asset for the company and we give a new name to that asset, and that asset is not books, not laptop, not a debtor, but the asset is a new asset called advance rent. The company paid advance rent. The company paid advance rent of 24,000. You may ask a question, why is advance rent or how is advance rent an asset? It is an asset because it has the ability to give the benefit to the company, and that benefit is to use that shop or a building which the company has, for which the company has paid money. Okay, so advance rent. So what happened to this transaction? So the cash has come down and an asset has been shown, which is advance rent. Is there any change in the books? No change in the books. No change in the laptop, no change in the debtor because we have not collected money anymore, but a new asset has come into picture and the new asset is advance rent. Is no change in the capital, no change in the creditor, no change in 10% loan, no change in profit because this is not an expense of the current period. The period is accounting year, the current accounting year. This will be a benefit. So this will be an expense to be treated in the next year. But you may ask, why did we show it? Because of the accrual. The moment I pay money, I have to show. The moment I create a liability, I have to show. The transactions should be recorded at the time of happening of an event, okay? So no change in the commission payable. So let us see the total of sources. Total of sources is 542,500 and the total of asset is 500. So observe, what did we do? Let us recap. All that we have done in this exercise is to convert this set of transactions, business decisions, into accounting equation. We have not yet converted into financial statements, okay? We have said that business decisions can be converted to financial statements, but before that, we are using the help of understanding the concept of accounting equation. So every transaction will affect the accounting equation. The principles on which it will affect is the business entity concept, accrual concept, and accounting period concept. Now, another thing observe, all these items that we have entered all have a financial value. So therefore, accounting is also said to be a money measurement, okay, money measurement concept. The money measurement concept says that only those transactions which are having some money value will be recorded. So if the transaction is not having money value, then you don't record in the books. That's one. The another important transaction, another important concept is a going concern concept, okay? The going concern concept says the business was there, business is there, and business will continue to be there. I repeat, business will continue. Business will continue as a going concern. How will you know that the business will continue? So you have to observe some transaction. For example, the business has paid rent. So that means next year they would like to continue. So going concern concept, money measurement concept, accounting period concept, matching concept, accrual concept, and the business entity concept are the important or the fundamental principles around which the accounting is based. So therefore, when you observe a business decision and would like to understand the impact on the financial statement, for the time being we are doing through accounting equation, we have to remember that this effect is not arbitrarily recorded. This entire process is governed by certain concepts, and that is a business entity concept, accrual concept, and accounting period concept, measurement, money measurement concept, and going concern. To summarize and move ahead, so this equation we can also present as a very simple. If you remember, we have we said that accounting equation can be presented as A is equal to, right? A is equal to, so let me change the color. So A is equal to E plus L, right? A is equal to, so A is equal to E plus L, right? So let us call this accounting equation. So accounting equation is summary accounting equation. That is the detailed accounting equation. So the summary accounting equation will look like this. The summary accounting equation will be A is equal to E plus L, right? A is equal to E plus L. Now, instead of showing all the items, let me put the last one here. So assets are cash plus books plus laptop plus debtors plus advance rent is my asset. Supported by equity, equity is capital plus the profit. And the liabilities are creditors plus 10% loan plus the commission payable, right? So can we see whether A is equal to E plus L? A is equal to E plus L. We can see that 542. So therefore, at any point of time, A will be equal to E plus L, right? A will be equal to E plus L. We can so therefore, but the details of the equation, details of L, details of A, details of sources can also be shown. Otherwise, accounting rotates around this accounting equation. Any company you pick up, you can see the accounting equation. For example, okay, this is the accounting equation of FANG, the Facebook, Apple, Amazon, Netflix, and Google. So therefore, what is this accounting equation trying to tell us? As we move along, we'll observe that more, that Facebook, 76% of the assets are financed by equity and 24% of the assets are financed by liabilities. So accounting equation will also help us in understanding the financing decisions, understanding the accounting decisions. So accounting equation is a very interesting and a simple relationship between A and S, but however, can be used for examining various decisions. So let me come back to so the objective of this particular first session, this session was to explain the concept of accounting equation and some important concepts and conventions and some important terms that we have seen. The terms are creditors, the debtors, capital goods, revenue goods, capital, and loan. So these vocabulary and these concepts and convention are the foundation for the rest of the reporting when you get into more and more complex and complicated transactions. So thank you very much.